Hi, my name is Joshua Curtis. I'm an attorney at Beresford Booth, and I'm going to be talking today about buying or selling property using a lease with an option to purchase. And this typically comes up when a seller is willing to have seller financing, where the buyer would buy the property, borrow money from the seller to do that. And so comparing a normal sale with seller financing with a lease with an option to purchase is kind of the way that we'll be working through this. So we'll be talking about what the different pieces of it are and how they can be adjusted to fit different circumstances, when it can be used, what some benefits are, some risks to buyers and sellers for this. So we'll jump right in here. All right, so here's an example of a lease with an option to purchase. So we have our purchase price of $500,000. That's something that's negotiated now between buyer and seller. They're going to negotiate for a 20% option fee, although it could be a different percentage. So that's $100,000. They're going to negotiate for $2,500 a month in rent. And then the tenant slash buyer has 3 years to execute on the option to close on the sale. And then all the terms of that sale are going to be in the option agreement. So it's essentially a sale where they decide on the terms now, but closing isn't until later. But there's an ongoing relationship. The lease provides the occupancy of the property, and then the option agreement provides the ability to buy it upon those terms at a later date. So let's now compare that to a seller finance sale. So if same basic set of facts, so we have our $500,000 purchase price. We're going to have a down payment of 20%, so $100,000. That leaves a loan amount of $400,000. The parties are going to agree on an interest rate of 7%. And I did a 30-year amortization, which is pretty typical. Even though it's going to be due in 3 years, the payments are made as if it was a 30-year amortization. So the payment is $2,661.21 per month. And the loan is secured by a deed of trust. And the amount of principal that this buyer would pay in 36 months is $13,092.15. So just like a typical sale where the buyer owns the property and the lender has a lien on the property for the mortgage, for the promissory note, this would, in this scenario, the buyer would own the property and the seller would have a lien against the property for that $400,000. Principal and interest payments are being made on that 30-year amortization, and the buyer has a 36-month window to refinance with a more traditional lender. So now let's try and compare how these two interact together. All right, so now this would be something I might do for a client if they're thinking about doing a traditional sale with seller financing, but they're nervous about transferring the property before they've received all of their money. So we can do a lease with an option to purchase that mirrors that sale term. So we have our $500,000 purchase price. We have our option fee, which is 20%, that mirrors the 20% down payment. So that's money that the seller gets immediately, and then it's applied to the purchase price later. Rent, instead of in my last example, I did $2,500. Now rent is going to be $2,661.21, which mirrors that mortgage payment under the previous example. And then the option deadline to buy the property is going to mirror the loan maturity date of 3 years. And then the portion of rent that would have been principal. So if you looked at an amortization table on that last one, 36 months later, there was $13,092.15 paid in principal. So that can be offered as a credit to the buyer. So now the buyer in the option example here is exactly the same dollars and cents wise as if they purchased the property now with a $400,000 loan at 7%. They're in the same place 3 years later, as long as they close on the purchase and buy the property. They got their 20% down credited as a toward the purchase price, so it's like a down payment, and then they got the portion of rent that would have been principal credited toward the purchase price. So sometimes clients want to achieve the same example, but not actually transfer the property. So this is a way to do that. All right, let's look at my next example here. All right, so next example. Now this so it can be used when there's a low down payment. So if we have our purchase price of $500,000, but let's say the buyer can only bring in 5%, 25,000. So that means we have a loan amount of 475. So we're going to have our interest rate of 7%. The mortgage payment goes up because it's a higher loan amount. We still have our 3 years, still secured by a deed of trust. And then the principal is paid in 36 months is a little bit higher because there's just simply a larger loan amount. So we could mirror this same transaction in a lease with an option. So we have our purchase price of 500,000. The option fee, sorry, that's supposed to be 5%, 25,000. The rent is now this higher amount equal to what the higher mortgage payment was. We still have 3 years, and then we still have that same amount that would be credited to the buyer. So someone might want to use this when the down payment that a buyer is offering is lower, because that creates more risk. I'll show you here. So um, if someone defaults on a deed of trust, there's a foreclosure. The statute says that it takes at least 190 days, but typically more like 10 to 13 months. And there's going to be fees for doing a foreclosure, trustees fees, recording fees, service fees, title searching fees. So let's say 8,000 plus in fees and costs. And you don't receive any mortgage payments during that entire time. So you're looking at potentially a year of not receiving any mortgage payments. Now, with a lease with an option to purchase, if the buyer defaults, the answer is an eviction. So an eviction might take 6 to 8 weeks. There's a lot of things in flex in the residential landlord tenant laws, and so sometimes it could take longer. It's a little bit unpredictable, but certainly less than a year. Maybe a little bit less expensive because some attorneys do just evictions, so they're pretty efficient at it. There's still no rent payments received during the default, but it's a shorter period of time. And then you could also have a default that's a non-monetary default. So they're still paying rent, but there's some other thing that they have done to be in default. And in that case, usually we have the lease. They could be in breach of the lease, and that would cancel the option. So if they caused damage to the property or did something like that, the seller slash landlord could continue having them as a tenant, but terminate the option so they don't have the ability to buy. So that creates leverage for the seller in that case. All right, so we talked about that this could be used where there's low down payment. So a low down payment results in a higher risk of default because the buyer simply has less skin in the game. If their situation changes or markets change, they have less ability or less incentive to make this work. So, but because title hasn't transferred, the foreclosure isn't necessary. And and then the reason why it reduces this risk is because it just simply shortens the time between when if a buyer defaults and when they can resolve that by getting the buyer out, getting, in the case of a lease with an option, doing an eviction versus doing a foreclosure later on. These time benefits are the same, even if there was that 20% down payment. It's still, if the buyer defaulted, the seller could still recover that money or recover the property. All right. So time is the major benefit to doing the lease with an option to purchase. So, all right, now here's some other situations where maybe it would be used. Sometimes people want to sell a property with an existing mortgage still in place. Sometimes this is family members wanting to sell. I've had it come up in probates, various reasons why, they want to keep that existing mortgage, but still the seller has some equity that they want to be paid for. So they can do a sale or do a lease with an option to purchase type of sale when there's an existing mortgage. It probably still violates the due on sale clause, which is a clause in a mortgage that says you can't transfer the property without paying off the existing mortgage. A lot of those define a transfer as a sale, like you'd normally think about, or a lease for more than a certain amount of time, or sometimes they even define it as an option. Um, so it can be used when there's an existing mortgage. It doesn't require, a large down payment. Sometimes if someone had a $200,000 mortgage on the property, if the buyer could bring in a $200,000 down payment, then they could pay off that mortgage. But if they can't afford to bring in a $200,000 down payment, they could use a lease with an option to purchase because that other one doesn't have to be paid off until the sale closes to the buyer, at which point it gets paid off. Another example of when this can be used is when someone they just can't borrow right now. So for whatever reason, I've had couples who are in a divorce. I've had couples or an individual who has bad credit because some negative thing that happened, but they just need some time to clean up their credit, resolve some other issues in their finances, and then they can qualify for a loan. So sometimes we use this where it's just a matter of timing. The buyer will have the ability to qualify for a loan and buy it, but just not right now. So we sort of create a window of time in which they have a little bit more time to do what they need to do to be ready to go qualify for that typical mortgage loan. All right. So here we have some risks. So one risk is that the tenant can default on the lease, and then you have to evict them. That same risk is present if they were to buy with a normal sale with a deed of trust. There's still the possibility that they default on their loan, and you have to do something. So I guess this is a risk with either of these, just because you're acting as a lender, and banks have thousands and thousands of loans. They spread this risk out over a whole bunch of loans. So one non-performing loan isn't the end of the world for a lender. It's a little bit bigger deal for you. Um, all right, then the second is that they may not be able to actually close on the transaction. So, or that they may not close on the transaction. So this is a problem. Values have gone down, then the seller will be out some amount of money because if you have a $500,000 property, the buyer slash tenant, let's say we have our 5% example, so they have $25,000 in, but property values go down by $100,000. Well, they're not going to buy it at $100,000 below what they agreed to. They'd rather lose their 25,000, and now the seller's stuck trying to go out and sell a property that's worth $100,000 less than they had originally tried to sell it for, and they only got 25,000 as an option fee in between. So another one is that the tenant or buyer can cause damage to the property and then decline to close on the purchase. I've had that happen to clients before as well. And then the Residential Landlord Tenant Act still applies. There is a provision that allows the cost of maintenance and a lot of landlord duties to be shifted to the tenant. But that law is really meant to protect tenants. And so some of those tenant protections are still things that that might come up as potential friction between the buyer and seller. And, generally in these, as long as no one is trying to get out of the transaction, as long as everyone wants it to go through, it usually goes through pretty smoothly. It's when a buyer decides they don't want to close, but they don't want to lose their option fee, or a seller doesn't want to close because maybe property values have skyrocketed in that amount of time, and so they have a little bit of buyer's remorse making the deal that they made when they made the deal, and so sometimes it's when either of those. When their interests aren't aligned, then people are looking for reasons to get out of this, and landlord-tenant laws could be one of those ways that someone is looking for somewhere, looking for an answer. All right. Now some risks for the buyer. So, there's a risk for the tenant buyer that they can't qualify for a loan. So right now they think they can in 3 years, but maybe their employment changes, they get divorced, they get relocated for work. I mean, there's a lot of things that could make it's hard to look into the future a number of years. My example, I did 3 years, but it could be 5 years. So it's hard to look into the future 5 years or 3 years and know what you'll be able to do. Know what your financial situation is and what your borrowing situation is. Also, number two here is if the buyer slash tenant defaults, the foreclosure process allows them a lot of time to cure. They have more time to market and try and sell the property. So those are all, if there was an actual purchase with a promissory note and deed of trust, the law has built in more protections for them as far as what they can do if they end up in default. Number three here, they forfeit their option fee if it isn't purchased. So, if their situation changes, and I've had it simply be that someone just doesn't want to buy this house anymore. It's not the right fit for themselves, their family, whatever, and they don't have the ability to sell and get their option fee is similar to a down payment. They don't have the option of selling and getting that back or getting the equity that's built up for 3 years. They have to either forfeit their option fee or buy the property and then turn around and sell it, or negotiate with the seller, landlord, for something, some other buyout of their option or something like that. Also, there can be negative impacts on title due to the landlord, seller person. If they have a tax lien against them or a judgment lien, those things can attach to title, and then, typically the amount of money from a sale is enough to pay off a lien. But if it were, astronomically high, then it creates problems that with closing, because there's a lien potentially on the property that's the value of the payoff amount of that lien exceeds the proceeds from the sale. And then also the buyer is essentially paying a mortgage payment. We try to mirror that transaction, but they're not getting any credit for the interest that they might be paying. So, there's a lot of reasons why someone might want to use this. I mean, typically it's when they see a lot of risk to having to go through the foreclosure process, because they can make, if the buyer defaults, they can remedy that faster, get the property back on the market. So it's a cash flow issue. They have less time that they're not able to collect payments. They can get things resolved faster. So, if a buyer is higher risk, it's more likely that maybe a lease with an option would be a solution to that problem. If a buyer has 50% down and excellent credit, then probably a sale, a typical sale with a promissory note and deed of trust for the seller financing would work fine. But where, it's maybe on the bubble or significantly under. I mean, in my 5% example, there's no way a seller should accept only 5% down on a seller finance deal. And FHA can do that because they charge for insurance and they spread that risk out over, thousands and thousands of loans. Individual can't do that, and probably shouldn't be lending with owner financing on a 5% down transaction. So, each one of these deals is often a little bit different. There's different facts, different situations, different reasons why we might be using a tool like this, but it's a tool that we can use when, if seller financing is a possibility, then selling with a lease with an option to purchase is also a possibility, and maybe it fits the situation better than just doing a typical closing with a seller financing. So if you have any questions about this, you're interested in exploring the options, maybe you have a particular sale that you're trying to do or a purchase you're trying to do, and seller financing is a component of that, then I'd be happy to talk with you. There's a lot of different sort of ways that these different pieces get moved around and can be used in different situations. So, every situation is unique, but it's fun to use the tools to apply to those different situations and try and find solutions. So thank you for listening today. I hope that you found something here useful and educational and interesting. Have a nice day. Thank you.